Hi, I'm Sharon Kreider. I'm here in the Western CPE studio in Bozeman, Montana, and we're going to look at questions and answers that have come in from our webcast viewers on day one, the individual day of our webcast. This is just to let you know what your peers are asking, to know a little bit extra. And the first question is on our individual taxpayer about a QCD, Qualified Charitable Distribution. So our webcast viewer asked, can my client make a QCD, Qualified Charitable Distribution, from her IRA to a charity by April 15th, 2021 and have it credited to the 2020 taxes? That's not exactly the right question. I think we have other things to talk about on the qualified charitable distribution, but let me just back up and talk a little bit about what the QCD is about. So a QCD by an IRA to a charity has to be done by the end of the year, by the end of 2021, for example, or by the end of 2020, if you want to qualify it against that year's RMD. So since the 2020 RMD is waived, you may request a QCD in December or in April because it's not going to apply as we usually think about it against an RMD. The bigger question is, should you do an RMD in 2020 or wait until 2021? Now, I may want money in 2020. I may need, because of everything going on, I'm 72 and a half, I have an IRA, and I'm charitable, and I am going to make a large contribution. Should I just go ahead and make a QCD? That's one question. I don't have any money, or my children or grandchildren need money because of the COVID pandemic. I may want to draw out money from my IRA anyway, even though the RMD is not required for 2020. But let's go back to say I'm charitable, and I want to make a large charitable contribution before the end of the year. Then I could still use my QCD. I am going to make this contribution whether I draw it from my IRA or not. I'm going to pay this money out because I need to do something for the people who have a lot less than I might have. So I'm going to make this $25,000 contribution, let's say. I can take the money from my stock. I can sell stock or give stock to the charity. I can take the money from my money market, or I can take it from my IRA. Which is advisable? What would we tell the client about making that large contribution? We would say to the client that you're better off, in sort of general terms, taking it from your IRA, because when you die, your beneficiary has to withdraw the money in your IRA over a 10-year period of time, with some exceptions like the surviving spouse or a child under 18. We have that in the webcast. The beneficiary has to draw the money out within a 10-year period of time, and it's ordinary income to the beneficiary. If the beneficiary receives my money market account, good for them. If they receive my stock, it steps up to fair market value at date of death, good for them. So what might be advisable when you're talking to a client is to say to them, if you're going to make a large contribution, the QCD still needs to be considered. Now, our questioner really said, wonder if I wait till April 15th, 2020 to do the distribution. Well, if I actually made my distribution in April of 2021, then that could apply against my RMD calculation for 2021. So that's the answer, sort of a little bit broader, a little bit deeper than maybe the questioner was really thinking about. For purposes of estimated tax payment penalty, if someone makes a Roth IRA conversion in the fourth quarter of 2020, are the taxes related to that conversion due January 15th, the fourth quarter payment? Or is an IRA distribution considered to have been received ratably through 2020? If the Roth conversion is in the fourth quarter, you can use the annualized method to calculate the 2210 penalty. Under the annualized method, tax on the conversion is due January 15th, so it's a fourth quarter payment. Is a qualified appraisal needed for the contribution of cryptocurrency? Now, about charitable contributions, the IRS, in a notice and a revenue ruling, labeled cryptocurrency as, if I can do air quotes, personal intangible property. It appears thus that your client would need an appraisal if the value of the gift is more than $5,000. The IRS has not specifically answered your question, but to be cautious and to file the rules that otherwise apply to personal intangible property, get that appraisal. Oh, a long question from Neil. And I do know that this is a question that's been bothering us since TCJA changed the deductions for equity borrowing from my personal residence. So bear with me. I'm going to give you a really long question. I have several clients that have mortgages that are over a few years old, and they consist of multiple refinances. Some for home improvements, some from boats, vacations, credit cards. In some instances, there are more than 5 or 6 refis over the past 20 years. No one saved their HUD-1s for the refis because under the old rules, so long as the debt was secured by the primary residence, the interest was deductible as equity borrowing. Now, under the new rules, some of the interest would technically not be deductible since the debt was not all acquisition improvement debt. How do you determine deductibility now? Well, Neil, that's a good question that we need to do some due diligence on. We need to work a little bit with the client on this. We've been talking about it in our classes, trying to get ahead of it. Neil, I think we start with the worksheet and calculate the balance which would be on the home acquisition debt from the original purchase. So I figure out that 20 years ago on this house I had a $200,000 debt. And I figure out what the balance on that would be at the today. And that'll be my original acquisition indebtedness balance. Then I ask the client to tell me the dates and costs of substantial improvements to the house. I think they can do that for me. They put in the new kitchen and it cost $45,000 and they did it in 2013. You know, I think the client can do that for me. And then I want him to tell me if the money for the new kitchen came out of a refi. All right, so what I'm trying to do is figure out original acquisition debt, get some numbers for substantial improvements, and put those in with a date and a description and an amount. And that should come up with an adjusted acquisition cost. And I do know from the 1098 mortgage interest what the balance is now, what the balance on their loan is. So I'm going to, this is not exact. It's not even science. It gets to be artwork at this point. But I need to do something to help the client, and I want some backup for it. So I'm saying, when I answered Neil, I said, Sharon says this is the best that you can do, is come up with a worksheet for the client. Some of the clients will be able to fill out an Excel for you and do this little bit of homework. Some of the clients will put it on yellow stickies, post-it notes, and you'll have to put together a worksheet. But I'm still thinking that you and I, to help this client, have to come up with some kind of approximation of their adjusted acquisition cost and what they borrowed out of the equity in their home for vacations and credit cards and other personal items, the trip around the world. We have to do something on that. So that's my answer for Neil, best we can do. If a client took a distribution from her IRA due to COVID and she doesn't pay the money back in 3 years, what happens? If you don't pay back COVID-related distributions, you pay tax on the distribution. There's an FAQ from the IRS, Coronavirus Relief for Retirement Plans and IRAs. The IRS FAQ says, distributions are included in income. They're generally included ratably over a 3-year period of time, starting in the year that the client received the distribution, 2020. So, if our client received, let's say, a $9,000 coronavirus-related distribution in 2020, the client could report $3,000 in income on 2020, 21, and 22. So they could break the distribution over a 3-year period of time. They can, however, report the entire distribution in the year of the distribution. So in our example, our client could report the whole $9,000 in 2020. The client can recontribute all or a part of the distribution to their eligible retirement plan, including an IRA, within 3 years, beginning on the day after they receive the distribution. Repayments are treated as though they were eligible direct rollovers. Amounts repaid are not subject to any other contribution or rollover limit. So let's say that our client reported $3,000 in 2020, $3,000 in 2021, and in 22 they repaid the whole $9,000 in the right time frame. They'd be allowed to file amended 2020 and 21 returns to remove that income off of their tax returns. All right, so that's how it works. This COVID-related distribution from the IRA or the retirement plan, the relief in the CARES Act was about the penalty, the 10% penalty. It was not about tax, other than allowing our client to spread the income over the 3-year period of time, a benefit for the client. Thank you. I'm Sharon Kreider at Western CPE.